Hello, world. Welcome, I am your host Mr. STAG. Today we will be discussing Bill Ackman's recent Netflix purchase. Seeking to capitalize on a steep sell-off in Netflix Inc., ticker symbol NFLX. Over the past several months, Pershing Square Capital leader Bill Ackman revealed a stake in the streaming giant earlier this week. In a letter to shareholders released on Wednesday, the billionaire activist investor said the New York-based hedge fund has invested in 3.1 million shares of Netflix since last Friday, making it one of the top 20 shareholders of the company. The total value of the stake is roughly $1.1 billion based on current share prices. Netflix shares soar over the past decade as it pioneered a streaming service that upended the traditional viewing experience. Competing platforms from Disney, Comcast and Viacom's CBS, among others, have slowly started to encroach on its subscriber growth. Netflix's stock has tumbled more than 40% from its intraday high of $700.99 per share reached in November. Netflix is a primary beneficiary of the growth in streaming and the decline in linear TV driven by its superior customer experience, a vast and diverse amount of superb, constantly refreshed content, global improvements in bandwidth, and the proliferation and continuous improvement and convenience of devices on which one can watch. Netflix's business has highly favorable characteristics which include, its subscription-based, highly recurring revenues, which have enormous future growth potential, a truly best-in-class management team and unique, high-performance culture. Consider Netflix's remarkable pivot from DVD rental by mail, to video streaming, to becoming one of the greatest producers of beloved content ever, economies of scale and superb quality in its industry-leading content, which should continue to drive future growth and widen the company's powerful competitive moat, pricing power derived from the enormous value it delivers to consumers compared with other alternatives, substantial margin expansion, with the opportunity for continued improvement due to economies of scale and the company's rapidly growing, global subscriber base, an improving free cash flow profile which should allow for continued investments in growth as well as the return of cash to shareholders. Last week, the stock declined another 20% after the company warned subscriber growth would slow substantially in the first 3 months of 2022 and provided disappointing guidance. While Pershing Square had been actively analyzing Netflix in connection to its investment in Universal Music Group, Ackman noted in his letter it was this decline that led to finally pulling the trigger. Ackman acknowledged the scale of the streaming business, which has the potential to attract subscribers and charge them higher prices, was part of what initially attracted him to Netflix. He also pointed to its large pipeline of content, which could help fend off competition and boost margins. In order to fund the purchase, the guru disclosed the firm unwound its substantial majority of its interest rate hedge, generating proceeds of $1.25 billion. Had we not sold the hedge, we could have likely realized more gains based on the increase in rates, largely today, since our sale, Ackman said. That said, we believed the opportunity to invest in Netflix at current prices offered a more compelling risk-reward and likely greater, long-term profits for the funds. With a $170.15 billion market cap, Netflix shares were trading 7.7% higher on January 27, 2022 at $387.46. The opportunity to invest in Netflix at current prices offered a more compelling risk, reward and likely greater, long-term profits for the funds. Ackman invests in hedges not to protect the funds from a short-term mark-to-market loss, but rather because they can become a large source of potential liquidity at precisely the time stocks become cheap. He invested in out-of-the-money interest rate swap options in December 2020 and early 2021 because we believed that it was likely that the combination of aggressive fiscal policy, monetary policy, and the reopening of the economy due to vaccines would cause non-transitory inflation, which would require the Federal Reserve to raise rates. He believed that an unexpected rise in rates could cause a market correction. Ackman's portfolio of companies are extremely high-quality businesses that can withstand inflation as they have the ability to price their highly desirable products, services, and assets to preserve their profitability in an inflationary environment. He does not believe that the recent move in rates has had any meaningful impact on our company's intrinsic values. Many of his best investments have emerged when other investors whose time horizons are short-term, discard great companies at prices that look extraordinarily attractive when one has a long-term horizon. Pershing Square's fourth quarter 2021 equity portfolio has not yet been released since it has 45 days after the period ends to file with the Securities and Exchange Commission. Known for its activist investments, the hedge fund takes large positions in a handful of underperforming companies and works with management in order to unlock value for shareholders. Over 80% of Ackman's $9.46 billion equity portfolio, which consisted of 6 stocks as of September 30, was invested in the consumer cyclical sector, while the real estate space represented 12.64%. As of the end of the third quarter, Ackman has positions in Lowe's Companies Inc., Chipotle Mexican Grill Inc., Hilton Worldwide Holdings Inc., Restaurant Brands International Inc., The Howard Hughes Corp., and Domino's Pizza Inc. The stock is currently undervalued according to Simply Wall Street by 47.7% with a fair value price of $739.57. Netflix will continue to grow in this current inflationary environment since it can raise prices without raising costs. Tell us what you think about the future of the Netflix and the streaming industry in the comment section below. Mr. Stag logging off.